We're back with our guest, Nick Rosenthal, with Griffin Capital. Appreciate you being here today.
Happy to be here.
We want to talk commercial real estate.
Absolutely.
Griffin Capital, I think you guys manage roughly $15 billion, a big segment of that in the commercial real estate space.
Sure.
And it's apparent and obvious that COVID's affected the commercial real estate markets in very different ways. We've been talking to clients who are asking us, well, how is that market? What does commercial real estate look like? And kind of make the analogy, that's like asking us what the weather is in the United States, right?
Yep.
Depends on where you are. If you're on the East Coast, it's freezing and cold and not where I want to be. If you're on the West Coast, it's 75, sunny every day, and you're probably at the beach, right? So talk to us for a minute about what's happening in the commercial real estate space. Where are the challenges and where are the opportunities?
Sure. I think first and foremost, one of the questions that we continually got over the last 14 to 16 months was what's going on with office. There was this immediate association that commercial real estate meant office. As you guys know, office is merely one sector of the commercial real estate market. Just like equities have different sectors and fixed income have different sectors, so does the commercial real estate market. And so as we think about the major food groups, certainly it's multifamily, it's office, it's retail, and it's industrial. And COVID had a pretty dramatic impact on each sector in different ways. Mm-hmm. The first thing I'll say just from a macro perspective is the sensationalist headlines did not materialize. So there was not this massive collapse in the retail space. There was not this massive collapse in the office space. Apartments actually hung in very, very well. Industrial, I would say in a lot of ways, was a beneficiary from COVID. So definitely different sectors having, different ramifications as a function of COVID. If you think about sort of the places where people were most concerned, and let's talk about office kind of chief among them, we saw a lot of sublease space rack up, which is a leading indicator of stress in the office market. Effectively, it's users saying, if I have 20,000 square feet on an 8-year lease or a 10-year lease, I don't know effectively how many employees I'm going to bring back to the office, and therefore I might carve off 5,000 square feet and try and find another tenant to take that obligation from me over the length of the lease. And that's generally a leading indicator of softness in the market. When you look at markets that saw sublease space start to expand really quickly, is markets like Manhattan, markets like San Francisco, a lot of that sublease space has now been taken off the market. So what we're seeing is employers are calling their employees back to the office. It was kind of, an interesting experiment. It worked well initially, but employers want to have the cultural benefits of having employees collaborate. I think they want the accountability factor of having people in the office being supervised. And there's just a social aspect that people crave about interaction. So the osmosis that happens with people being together and sharing ideas, trying to get to a common outcome, is something culturally that companies have said, we really want our employees together. So they're calling people back in a big way. When we look at retail rent collections dipped into the 40s nationally. So effectively, if I owe $1 of rent in March of April of last year, I may have been collecting 45 cents. That number's now back up into the high 80s, the low 90s. When we look at multifamily was very, very resilient. Really, as you think about sort of what's happening in the apartment space, it's needs-based. People need a place to live.
Especially on the higher end.
Yeah. And effectively, as housing prices have accelerated, certainly that's put pressure on the single-family housing market. We just have a very significant portion of our population that's younger, and those folks tend to be renters. They have households that are being formed later in life compared to older generations. They put a premium on mobility. So those folks are renters. They're going to be renters for a long time. So rent collections really dipped at their low to about 94%. They're back up to pre-pandemic levels. So the multifamily market is very strong, and there's a tremendous amount of pent-up demand right now with apartments in terms of tenants. So right now, when we look at demographics, that 18 to 28-year-old demographic is predominantly, 52% are living at home. People quarantined at home. They said, I'm going to work from home for a little while. So they moved home to save money, and they weren't being social. So it didn't impact their life that much. Now they want out of their house. Their parents want them out of their house. And so that's the most people in that age demographic we've had living at home since 1940 in this country.
Wow.
So apartments are already full, and all these people are now moving into apartments. And what COVID has done is it's accelerated population mobility into the Southeast and Southwest and through Texas. So older people decided, I want to retire. I want to go to lower income tax states. I want to go where the sun shines, and they moved. Younger people said, I want to go where the sun shines. I want to go where there's a better live, work, play balance. I want that lower income tax. And effectively, employers followed them there. So certainly California has seen a lot of employers leave, a lot of people leave to go to markets like Austin, go to Dallas, go to Phoenix. New York has seen an exodus of people going to Florida. So what we're finding is just a lot of population mobility accelerating the demand for rental housing in these markets, and apartment landlords are able to grow rents as a result of that. Warehouses, certainly e-commerce exploded through the pandemic, but e-commerce is still only 15% of retail sales. So there's a tremendous amount of growth still to be had there, and the younger portion of the population is very comfortable ordering things on their phone, not being inconvenienced by having a shopping experience, right? And now older people have been conditioned who weren't buying things via e-commerce to do that.
Right. I think that part's huge, right? Because you had the pandemic, those were the people that were at the greatest risk, right? It was the older demographic. And so a lot of those people had to learn how to shop online. And once you shop online, it's tough to go back to having, going to the store, picking things out when you just know you can have things delivered.
We've been calling it the Amazonization of our society. Yeah. Amazon, they came out with Prime and then free 2-day shipping. And it doesn't matter whether you're buying something for $5 or $500, it's going to show up on your doorstep in 2 days. I'd imagine that's made everyone else in that space have to basically play ball.
Yeah, and a couple other things have happened too. Right now, the consumer is stronger. The consumer is getting out and spending money. So retailers have to stock more goods. That has to move through a warehouse. Supply chain issues, because of lack of labor, amongst other things, have created big backups. So retailers want to stock more goods in warehouses, right? So there's this explosion of demand for space in the warehousing market, and landlords in that space are in a position, especially kind of that last mile warehouse, to grow rents in a pretty significant way. But who's the toll keeper to all this, right? All of this is going through a data center somewhere. It's going through a cell tower somewhere. So these specialty sectors are also big beneficiaries. And this is all at a time when last year, institutional investors took a step back. There was pause in the market. When you look at transaction volume in 2020, it was significantly less than prior years because people weren't sure about their investment thesis on a go-forward basis because nobody knew when COVID would be resolved, when we would be able to turn the corner, right? So as a result of that, prices didn't really run in real estate because of the lack of transaction activity like they did in equities, like we saw in the stock market, right? Mm-hmm. Or as interest rates went down, as we saw in the fixed income space. So on a relative basis, when you look at interest rates and the entry point to buy real estate or invest in real estate, that spread is very attractive relative to PE multiples in equities or yields in the fixed income space relative duration risk. So on a relative basis, real estate now becomes very attractive as we start to see this reopening trade, and we see a lot of capital lined up to invest in real estate. One of the interesting things to watch for this year is going to be a lot of money was raised to invest in real estate opportunistically, expecting a lot of distress. And the capital that was raised relative to the investment opportunity is a significant mismatch. There was a lot more capital raised relative to distressed investment opportunity. The only real distress that we saw manifest itself was in the retail space and in the hospitality space.
Right, hotels got beat up pretty bad.
Yeah, but you're going to see a recovery in the hospitality space.
We're already seeing that take place right now. I mean, as soon as our society started to get vaccinated, people were jumping out of their skin to get out of their houses. And so we're seeing RevPAR, revenue per available room, and we're seeing occupancies already rising. I mean, people are tending to drive to these destinations more so than fly. But over the Memorial Day weekend, we saw TSA numbers that we hadn't seen since, pre-pandemic.
Yeah, and bookings are, 80, 90% of pre-pandemic levels for airlines through the summer. So you have a society that is getting out, that is craving social interaction. What is going to be interesting is kind of this change from the consumer consuming things to consuming experiences. But, in theory, that's all good for real estate.
Let's talk for just the last few seconds here, a few minutes on the outlook going forward.
Yeah.
I think office, It was a dream that a lot of employees had, that they were going to be able to work from home forever, right? Hey, the industry's changed forever. No one's going back to the office. I think that dream, people are waking up, right?
Yeah.
I mean,
employers are calling their employees back to the office in droves.
Yeah.
So
office looks like, not necessarily a place where I think you're going to see a lot of investment per se.
Sure.
But it's also an area that I don't think is going to be devastated by COVID.
Yeah, we would agree. I mean, I think as investors, we think of, if I have a dollar, where do I want to invest that dollar? And certainly, what we find most compelling is some of the sectors that are underpinned by strong secular growth themes, like housing, right? I mean, we have a housing shortage. People need rental housing. Rental housing allows investors, in our case as landlords, to raise rents more quickly when you have that demand outstrip supply because of those short leases, which is what also makes the cash flows in apartments very dynamic, which is attractive as an inflation hedge, right? So we like multifamily, very constructive on the fundamentals there going forward. Same thing with warehouses. Life sciences real estate is very interesting. A lot of money being spent on healthcare, research and development, whether it's pharmaceutical companies, advancements in surgeries with robotics. All of that stuff is being done in life sciences facilities.
Quick question. Do you find a stickier tenant in that space due to the amount of capital that those businesses tend to invest, making the space compatible with what they're doing?
Yeah, sure. As you mentioned, kind of same story with data centers, where the infrastructure that it takes to run those facilities is pretty significant. Generally, the tenant is responsible for that cost, so they don't like to leave. Same issue with healthcare real estate as well. One of the things, that we certainly like about life sciences real estate is there's just not a lot of it. Where you see it most prevalent is where you've got universities, so you've got research programs with hospitals. So you see it down in San Diego on Torrey Pines Road. You see it in Boston with Mass General, Brigham and Women's Hospital, Harvard and MIT, BCBU, Northeastern right there. So there's just not a lot of these research facilities. You see it a little bit in Philadelphia with University of Pennsylvania. So, there's not a lot of it. There's a scarcity issue, which is always good as a landlord. And we like specialty sectors, right? People are always in transition. People are moving, as I mentioned earlier. That's good for things like self-storage, right? So these specialty sectors are doing well. And, where we think it's most compelling today is kind of these strong secular growth themes that are sort of independent in terms of their drivers relative sort of broader economic expansion. It just changes in the way demographics are in this country that are driving demand, or the way consumers are consuming goods.
All in all, commercial real estate, pretty healthy. Weather's pretty good, we could say, and the outlook looks pretty nice going forward.
Yeah, and I don't want to be too much of an optimist here, but where else do you get the yield, the tax efficiency in a financial asset that's got a positive correlation to inflation?
Yeah, certainly not fixed income, traditional fixed income. Yeah.
Right.
Awesome.
Nick, thank you very much for being here to join us.
Yeah, my pleasure. Thanks for having me.
Thanks.